Hello, I'm Dan, the Lettings Director at the Property Centre in Taunton. I've been working with landlords and investors for about 8 years now, and I've picked up a few tricks of the trade. This is how you can build a big property portfolio with just one deposit. This will be referred to as recycling money, leveraging, or positive gearing. So if you've heard those terms being thrown around, this is essentially what it can look like. People who could benefit from this video is if you're an accidental landlord, you've got one property, perhaps you bought an apartment, moved into a bigger house with your partner and kept yours as a safety net, and things are going really, really well. This might be how you go from 1 to 2 to 3 to 4 until you have a portfolio that you're happy with, essentially. So the way that this works, you basically are going to look to recycle your money. There are a few different ways that this can pan out. So the first one is buy, refurbish, and refinance. You'll see the BRR term thrown around in investor circles a little bit. Essentially, the way that this works is you buy a property that is less than perfect, that needs some improvements. Obviously, it's going to help if you're in a position where you can do some of those improvements yourself. So for this example, you're purchasing a property at 150,000, 37,500 in as a deposit, which is 25%. You're borrowing 112,500. You spend 20,000 on improvements. You put in your kitchen, you fix the dodgy roof. Maybe it's got a subsidence issue. You sort that out. The new value is 200,000 on the property. So you get a new mortgage on the property, leaving 50,000 in, taking that 150,000 as the new loan. 150,000 pays off the 112,500 mortgage that you had previously, leaving you with 37,500 in the bank. This, weirdly in this example, is your deposit exactly back out again, which means you've gone from 1 to having your deposit ready to do the next one. Obviously, this is all gross. This isn't accounting for solicitor fees, sales fees, mortgage arrangement fees, so on and so forth. But looking at this, an overview from a gross perspective, you've pretty much got your deposit back out of the property. And a property in the Taunton, Somerset area costing about 200,000 is roughly going to rent for about 1,200. So you've also now got an income coming in, hopefully covering the mortgage payments. So deposit in, first property, back out, ready to buy a second property and expand from there. You can rinse and repeat this as many times as you want, presuming the figures are correct. That is an example of how the BRR model can work. Second one is buy and hold. So in this situation, you buy a property, for instance, this one at £200,000, so 25% deposit, £50,000 in, borrowing £150,000. Typically, this is real difficult to put an average figure on because different parts of the UK perform differently. Different times the market is doing different things. It goes up, it goes down, it goes left, it goes right. But if we say on average prices go up by around 5%, over the course of 5 years, that property that was worth 200,000 is now worth 255,000. So similarly to the example above, you could get a new mortgage, putting a deposit of 63,750, leaving that in, borrowing 191 pays off the 150, leaving you with 41,250 in the bank. This is a more slow, steady way of doing things. Better if you don't have the expertise to go in and do the work. This obviously is quicker. You can also do a combination of the two. So let's say, for instance, you bought this property, did the improvements, getting it to 200,000, rented it out, you took your 37,500, you bought somewhere elsewhere. But this property now being worth £200,000 is essentially the same as this one. In 5 years' time, you've got another deposit there that you can refinance, keep the property let out, keeping the property as a long-term investment, and you have the deposit there to go and buy the next one. So you can kind of see how this can become a bit of a snowball effect. Your first property, if you buy it and you do the work, can be quite quick. Otherwise, it can take a little bit of time to have the finance built up to have another deposit ready. But imagine you had 10. Imagine you had 10 properties that every 5 years were growing enough that you could refinance all 10 of them. That way, every 5 years, your portfolio is essentially doubling in size, and so on and so forth. So the bigger it gets, almost the easier it is. Money attracts money is what we hear all the time. This is how some landlords have built a massive portfolio. However, it's very good to make the BRR buy and hold model look good on paper. In reality, it's not always as easy as it seems. For instance, at the moment, the BRR model is being hindered a little bit by a flat or decreasing market in which the cost of works are through the roof. So you might find yourself in a situation where you buy somewhere, you throw a load of money at it, and where the market has dipped a little bit, you're kind of at a break even, meaning you've improved the value of the property, but not enough that you could really pull the money out. Second thing to be aware of is market conditions. So property prices can come down, they might not perform as well. So it's better to have a property that cash flows that you'd like to pull money out of, not one that you need the money out of ASAP. And interest rates. So if you're borrowing money against a property that you're intending to let out, the bank will want the rent to be at least 25 to 30% more than what your mortgage repayments are going to be. Now, we are in a market at the moment where the interest rates on mortgages have gone up quite substantially. So where you might have bought a property 5 years ago and tied in at a 1 or 2% rate, that rate is now looking at 6 or 7%. The mortgage payments might be so much higher that you're not able to refinance because the rent isn't high enough to cover the mortgage repayments. So it might leave you with money stuck in the property, therefore meaning you have to stay on the rate that you're at, not remortgage and pull your money out, leaving it in the property and wait longer until interest rates settle or your rent comes up enough to cover that stress testing. So on the surface, this can work, and I think if you're looking to grow a portfolio, this should definitely be part of it. One of the amazing things about property is you can leverage and use finance so well to grow a big portfolio of assets as opposed to anything else like investing in the stock market. However, I think it's really important to be aware of when this can't work and factor that in as part of your plan.